Hello students, you are welcome in the Economica IAS YouTube channel. Today I will discuss economics optional for civil service means as well as for Indian economic services UGC NET JRF, and as in my previous lecture I have been explained neoclassical theory for demand for money. This demand for money theory, some portion I discussed neoclassical, that is Alfred Marshall and A.C. Pigot. Today I will discuss demand for money theory propounded by J.M. Keynes, John Maynard Keynes. You know, John Maynard Keynes clearly says the demand for money, this demand for money is basically because of three factors, that is transactive motive, day-to-day expenses, secondly precautionary, that is because of unforeseen condition, and third is speculative demand or speculative motive, means to earn more money by investing their money in the market by knowing better. This demand for money is main contribution of J.M. Keynes based to demand for money, also discussed by our neoclassical theory, but precautionary we are not focusing. Alfred Marshall, A.C. Pigot more and more focus on transaction motive. Today I completely focus on speculative demand for money because this transaction demand and precautionary, which is known as L1, generally transactive and precautionary demand for money, assumed by Keynes a function of income and rate of interest. Simple explanation I will discuss later because this is not a complicated issue. Complicated issue is the speculative demand for money, and why in the global economy 1930s Great Depression were occurred, that also explained by J.M. Keynes on the basis of this speculative demand for money. Students, Keynes state the example and explanation on the basis of a product of capital market known as bond. Actually, bond is a combination of two products. First, share. On share, what is the meaning of share? A part of capital of a particular company. It may be government or private sector. Generally, company manage the fund by selling its share, debentures, bonds in the market, and in this way they run their business. Shareholder always earn the profit or losses according to the earning of company profit or losses. Profit or losses, they generally known as dividend. This dividend may be positive or negative on the basis of company profit rate of return or negative rate of return. Second component, that is known as debenture. Debenture is nothing only the debt paper. When company sell out to the investors the debenture, company commit that she or he will pay a definite rate of interest on these debentures, and debenture holder will earn the rate of interest. Generally, bond is a combination of both. Now, I will analyze what is the relationship between bond and rate of interest and rate of interest, and why investors like to invest their funds in bond. On the basis of it, you can easily understand. Think, suppose a bond which provide a rate of return to the holder, say 1 rupees per year. Actually, what is this? This is the rate of return on bond in the form of interest rate. Now consider, Suppose the market rate of interest, market rate of say interest is 4%. Now you can calculate the price of bond in the market, and after then you can understand Keynesian hypothesis and theory very easily. You can calculate the price of bond is equal to rate of interest is say 4%, means 1 rupees upon 0.04. This is the rate of return on per rupees of investment, and we know the rate of return on bond or rate of interest on bond is say 1 rupees, then it will determine the price of bond. If you calculate these equations very easily, 100 upon 4 into 1 rupees is equal to 25 rupees. It means if the market rate of interest say 4%, then the price of bond will be 25 rupees. Again, if the price of bond or rate of return on bond remaining the same, say 1 rupees per year, but the market rate of interest increased from 4% to 5%, now you can calculate the price of bond very easily by the similar formula, say 1 rupee upon 1 point, this is 0.5%, or you will say that is 0.05 into 1 rupees, that is the rate of return on bond or rate of interest on bond. Now you can calculate 100 upon 5 is into 1 rupees is equal to 20 rupees per month. Now you are observing, if the rate of interest is increasing, price of bond will decrease. Investors always purchase the bond if the price is very low. What they will do? They will purchase the bond. Who will purchase? There are the two kinds of investors. First, you understand the relationship between bond price and rate of interest. If I plot this on a diagram, you can see, suppose this is the rate of interest, and say this is the relationship in the price of bond. At this point, price of bond is lowest, and at this point, price where rate of interest is very high, rate of interest is very low, price of bond is very high. What this picture shows? Investors will purchase the bond at a low price and sell out at the high price. This hypothesis based on the investors' expectations. What is the expectations of investors? That in present, if the price of bond is very low, it will increase in future, and in this way he will earn the profit. Say at this level, say price is 20 rupees per bond, and say is this level price of bond is 20 rupees per bond. In this way, the investors will earn 5 rupees say per bond and 1 rupee say rate of interest on bond. In this way, by knowing betterly on the basis of his rational expectations, he will invest in the market. That kinds of demand is known as speculative demand for money. Keynes further analyze this. On the basis of this explanation, Keynes also explained the liquidity trap, where there is no role of money supply in the determination of rate of interest, and it was main for failureness of monetarists or monetary policy during the recession period. After then there is the emergence of what? Fiscal policy. Now you understand Keynes explaining his explanation on the basis of two kinds of investors. One is known as bull, other is known as bear. Generally, bull always purchase the share when their price is very low or rate of interest is very high. If the price of bond is lowest, these persons will purchase the bonds. They doesn't create any kind of speculative demand because they invested their old funds which they keep in their pocket for the speculative purposes in the purchasing of bond. Again, there are those who will sell all shares or all bonds when its price is highest. If you see this point with the help of this diagram, you can easily understand. Suppose this is the speculative demand for money, speculative demand for money which is generated by our bears. This is suppose the lowest rate of interest. This is the lowest rate of interest and say this is the highest rate of interest. At this point, price of bond will be lowest. Price of bond is lowest. What does it mean? This bull will purchase all which they have money in their pocket, the bonds, and if the rate of interest is very low, the bears will sell out all the bonds and keep their money in their pocket, which is known as speculative demand for money. And this is speculative demand for money actually infinite, which is termed by Keynes as liquidity trap. Liquidity trap. Today I discussed this point. What is liquidity trap to you? I will further explain what is the role of money supply in liquidity trap and why the monetary policy failed to eliminate the problem of Great Depression of 1929 or 30s Great Depression. After then Keynes propounded the fiscal policy or budgetary policy. You wait for that particular lecture. Today I will discuss only one thing so that you can understand what is the quality of lecture and why I am focused on economics. I am teaching last 26 years and selections in different exams is more than 80-90%. It may be IAS, it may be Indian Economic Services, it may be UGC, NET, JRF. A number of students who teach, who were studying in my class, presently teaching in Delhi University. Some are IAS officer and some Indian economic servant. You can also enjoy the same benefits after coming in online, offline or hybrid classes. Thank you, students.